This is Unit 12, Module 12, Real Estate Financing. The Federal Reserve is responsible for monetary policy. The Fed aims to maintain steady economic growth with minimum unemployment and to keep inflation in check. There's four things the Fed can do for controls over monetary policy. The first is the discount rate, and you'll hear this occasionally during the day on business news where they'll say the Fed lowered the discount rate, and almost everybody thinks, oh, they lowered the rates, and I can go out and get a lower 30-year fixed rate. Well, that's not really true. It's probably a pretty good indication that long-term rates are going down, but the discount rate is a short-term rate that member banks can borrow from the Fed. So they can lower interest rates. That will probably equate to lower long-term rates in the short term. They can change the reserve requirements, which means they can instruct their member banks to either increase their reserve requirements, meaning make money more tight and they're lending less money out into the system, or they can reduce the reserve requirements, meaning they have to hold less reserves in their banks and they can lend out more money. Another way to control the supply of money is to regulate open market transactions, meaning they buy or sell government securities. If they buy government securities, then those proceeds of that money they pay back for those government securities releases more money into the system. Whereas if they sell securities, they're selling into the marketplace, they're pulling money out, so they're tightening the supply of money and creating a more tight money economic policy. The Fed, through the Treasury Department, can also create currency, but they need to watch that by releasing too much money that can be inflationary and may lead to a recession. Lower interest rates fuel the economy, they encourage growth and lower unemployment. However, that can result in inflation. Also, by lowering interest rates, you're creating demand, meaning the people going out to buy housing now have cheaper money to go out and purchase homes, which can create demand. We saw this in the early 2000s, which basically led to our mortgage crisis, where not only were there low interest rates, there were adjustable rates, there was no document financing, low credit scores could get financing, so it sort of created demand on steroids, where everybody wanted to go out and buy a home, which drove up sales prices. At a present supply back in that time, there was a fixed supply of homes with a huge demand going up, so the prices of real estate went up dramatically. Of course, interest rates too can slow the economy as the Fed raises the rates and the long-term rates follow and go up also. So lower interest rates encourage housing purchases and increase demand for homes based on a supply. In that case, if the demand goes up dramatically, meaning there's tons of available credit, the housing prices go up. Also, too, higher interest rates can affect affordability and cause real estate sales and construction to decline. So by having higher interest rate or less available credit or desirable credit, you're reducing this based on the supply. The demand goes down, sales go down, so the prices of real estate may decline also. The Affordability Index measures the median family income necessary to support a mortgage at the median price home. And basically what they do, the index is based on a scenario of 20% down payment, 30-year fixed mortgage, the current Freddie Mac interest rate, and the PITI, or principal, interest, taxes, and insurance payments not exceeding 30% of gross family income. With this in mind, what percentage of the population can afford a median priced home with a median family income? So hopefully you want to see that get higher as people can't afford homes, so it should approach 100%. But in certain areas like California, that's probably never going to happen because the median price home is so high. Of course, affordability is just a benchmark because lenders do allow families to pay more than 30% of gross income for housing and products, allowing significantly lower payments. And the affordability index best measures the changes in housing affordability. Of course, too, with different loan products, and interest rates does help with affordability. But the affordability index is just a snapshot of the market to see what people can potentially buy based on current incomes and median priced homes. What's primary and secondary financing? A primary financing is basically a first trust deed, meaning if there's no other loans on that home and you get a loan, purchase that property, then a first trust deed is going to be put on that property, meaning you have a loan against the property. Any subsequent trust deeds are secondary financing, could be a second or a third trust deed. First trust deeds have better interest rates. Second trust deeds normally are riskier loans in that you're encumbering your property and don't have as much equity in the property as some lenders may like to see. In this case, with the increased risk and the higher loan to value, the interest rates are higher, where second trust deed lenders and private lenders will charge more in an interest rate because of the risk factor than on a first trust deed. Now let's talk about the primary and secondary mortgage market. The secondary mortgage market, I should say first, does not mean second trust deeds. Primary mortgage market refers to a loan being made directly to borrowers, either from a bank, mortgage broker, or mortgage banker. So that's a first trust deed. Secondary mortgage market refers to the resale of existing mortgages and trust deeds, meaning as a mortgage banker, I make a loan, or maybe I go out in a month and I make $30 million in loans. Well, I'm out of money now. What can I do to recoup my cash? I can sell my loans into the secondary mortgage market. Maybe I'm selling that to a government service entity like Fannie Mae, Freddie Mac, or Ginnie Mae, or I may sell that into mortgage-backed securities. So what I've done through the course of the month is I've funded loans off my warehouse line of credit, and then I need to pay that back or pay it down so I can lend out more money. So I go out to GSEs, Fannie, Freddie, Ginnie Mae, or package loans into mortgage-backed security, sell it on the secondary mortgage market. That cash comes back to me, and I can go out and do more lending. So the secondary mortgage market basically buys the loans from the primary mortgage market and increases liquidity into the real estate market. So bottom line, it gives the primary mortgage market more money to go out and lend. So agencies that can purchase on the secondary market, more commonly you'll see Federal National Mortgage Association, which is Fannie Mae, and we'll talk about this later too. They'll do what they call conforming loans. Freddie Mac or the Federal Home Loan Mortgage Corporation, basically the same thing. Fannie and Freddie are almost identical. They'll do conforming loans. Another government service entity is Ginnie Mae, the Government National Mortgage Association. They predominantly buy government loans, which would be FHA loans, VA loans. There's also an agency for farm loans, and that's a Federal Agricultural Mortgage Corporation, formerly called Farmer Mac. Well, they'll buy farm loans. So let's talk about conforming loans. Conforming loans are basically called conventional loans. They're non-government loans. They meet the underwriting standards of Fannie Mae and Freddie Mac, and they're not insured by FHA or guaranteed by VA. So a conventional loan is not insured by FHA or VA. They're conventional loans. If they need mortgage insurance, they'll go out and get what they call private mortgage insurance. Some loans lenders keep, they want to keep them in their portfolio, so they're called a portfolio loan. Other times, people will keep loans because they want to retain the servicing, because there is a small spread contained in the interest rate where they can actually make money as they service the loans. This is 2020, and one of the things you should know is conforming loans change annually. So one of the things I've noticed is your book, even the latest edition, has the conforming loan limit of $424,000. That has actually changed. So in San Diego County for 2020, the conforming loan limit is $510,400. That's the conforming loan limit. In fact, now they have something new too, which is called a high balance conforming, and that is 710,500. So in either case here, either the 510 or the 710, those loans can be sold to Fannie Mae and Freddie Mac and are called conforming loans. Anything over that, say over the 710.5, they're called jumbo loans. Tighter underwriting, higher interest rates than the conforming loans. So you'll hear conforming loans and jumbo. Jumbo just means it doesn't meet the conforming loan limit, and you have to go out and get a non-conforming loan with non-conforming pricing. So what types of lenders out there? There are institutional lenders and non-institutional lenders. Institutional lenders include commercial banks, savings and loans, and actually insurance companies. Non-institutional lenders are mortgage bankers, private individuals, and real estate trusts. Commercial banks basically do short-term construction, short-term type loans, and one good example of that is our construction loans, where you're lending somebody, say, for 1 year, X amount of dollars to construct a home. After that year is up, then that short-term loan gets paid off. More commonly, what happens is the short-term loan is out when it gets paid off with permanent financing, what they call a takeout loan. Then they'll go back to the takeout lender. We use a Fannie Mae or Freddie Mac loan to pay off that short-term loan and have their loan in first position on the newly constructed house. Saving loans in the past have been called thrifts, and basically their lending is based on deposits. Their members come in and deposit their money. The thrifts, based on their reserve requirements, go out and lend money out for real estate lending. Today, both commercial banks and thrifts are more diversified. In fact, they may also be participating in other lending, like conforming lending and jumbo lending. Life insurance companies basically lend on large projects. They may partner up with a contractor or a builder and build large projects like strip malls or new home subdivisions. And being a partner, in many cases, when they lend money out, they'll get a partnership participation return at the end of the project also. Non-institutional lenders can include private lenders, meaning individual people, could be hard money lending. It could be seller financing, where the seller wants to carry a note for part of his equity as he sells the home, and then the buyer will pay him back at a later date. Also, we have mortgage companies, mortgage bankers, or mortgage brokers. Mortgage brokers basically are partners with mortgage bankers or larger banks, where they'll get a wholesale price and then go out and lend and deliver that loan back to the large bank for closing, and then they get paid an origination fee based on what they've sold. One of the pluses to a mortgage broker is they've got a large menu. Depending on how many investors they have, they can search for the best pricing and best program to suit their customers. Whereas a mortgage bank or a bank, sometimes you go to them and they have one set of programs. Maybe they only like an adjustable rate mortgage and they set their own pricing. Whereas a mortgage broker can search for the best pricing and the best program. Another avenue is real estate investment trusts, where people get together in a syndicate, pool money together, and then lend that out for real estate projects. Seller carryback financing is basically when a seller wants to use some of his equity and get a return on that, and maybe delay some of the tax consequences of capital gains because you haven't realized that money yet through the sale. You're carrying a second back to the buyer, or maybe you carry the whole thing back in the way of a first trust deed. In any case, the second trust deed is generally fixed rate. Normally they're 5 to 7 years. Most that I've seen are interest-only payments with a balloon payment, meaning that you pay, that the seller carried a second for, say, $100,000 at 6% interest, and the rates are higher for these too, and it's in a 5-year term. So 6% interest on $100,000 for 5 years, and then after 5 years, you have a balloon payment. you owe that $100,000. So sometime before that 60th month, you better start refinancing that property to to roll your first and second trustee together and pay off that loan that's coming due. Sometimes they may have prepayment penalties. 1510s would be another example. So either you're going to go out and try to find a second trustee lender to come in with a second with your first, because you'd like to get down to an 80% loan to value to avoid PMI, or the seller's going to carry something for you. So that's called a piggyback, a first in combination with a second trustee. Adjustable rate mortgages are not fixed rates. So if they're adjustable, that means they're going to change. And when they do change, here's some terminology. Lenders are lending money out to someone, and maybe initially that loan was fixed for 5 years, but now it's going to adjust annually. And when it adjusts, what does it adjust at? How do you come up with a new interest rate? And basically what happens is the lenders borrow money at a certain index. So they're borrowing money. They're going to add a margin to that, or the lender's profit over the cost of funds. That index is their cost of funds, what I'm borrowing money at. I'm going to add my margin to it, come up with a new interest rate, and give that rate to you to pay for the next year. An adjustment period may be, 1 year, 2 years, 3 years. More commonly today, you're seeing 5 years, 7 years, and 10 years. So you get fixed and then it'll adjust annual after that. The periodic cap protects you. You've got that loan for 5 years and now it's going to adjust annually based on the index and margin coming up with your new rate. What protects me? Could that go up to what the current market is? What if it's 10 or 12%? So you've got caps on those. So normally what happens after that period adjustment, when it's going to change, there'll be a cap on that. Normally it's 2%. And then overall, how much can it go up? You have an overall cap too, or a life cap, and that's normally 5%. You can have negative amortization on some loans. However, as here it mentions the option arm, those are gone and dead. An option arm worked like this. Somebody gets an interest rate, they're going to purchase a house, the lender quotes them 1%. You get 1% for a year. Okay, that sounds pretty good. I'll take 1% for a year. But what a lot of lenders fail to tell people in the form of disclosures, which has changed now, thank God, is that what happens with an option arm is you close, you get your option arm for 1% for 1 year. But the second month it adjusts, it goes fully indexed. Means that index and margin added together are now 5%. Okay? You're still paying at 1% because the lender said you could pay that for 1%. But now you're at 5%. So you've got a 4% difference. That's called negative amortization, and that gets added back to your mortgage amount. So your mortgage loan starts to grow, and that's negative amortization. In the past, too, there was a lot of arms that were convertible arms, meaning you got an arm for maybe 1 year at low interest rate periods, and you have that, but you had an option down the road to convert it to a fixed rate. So that's a convertible arm. You have an option to convert to a fixed rate. So other types of mortgages, and in fact, in today's market, there aren't many arms out there because people are going with fixed rates because the rates are so low. But an adjustable rate mortgage, or ARM, is going to change. And we talked about earlier, that interest rate, as it comes time to change, is going to change based on the lender's index, or what his cost of funds are, what he's borrowing at, plus a margin. And that's called fully indexed. So when it changes, you get the fully indexed rate, providing it doesn't exceed your caps, if you have caps on your loan. Now, the index, too, is out of the control of the lender. So some of the common indexes people were using were 11th district cost of funds, or the LIBOR interest rate, which is the London Index Bank Board index. So you initially started with a teaser rate. Maybe you started at 2%, but now it's going to change. And it's going to change based on that index on the cost of funds. So what would happen is, say you started at 2%, okay, and the index is 2.5. So the index is 2.5 and the margin's 2.5. So as it changes now, the index plus margin, 2.5 plus 2.5 is 5%. So you're going to jump to 5% over your teaser rate. And once again, hopefully you have some caps in there that keep it down. So in this case, if you had a 2% periodic cap on that, instead of 5%, you'd be at 4 because you started at 2, you have a 2% cap. So instead of going to 5, you're limited to 2%. I'm sorry, 4%. So some other definitions. The adjustment period is the period of an arm when it's time for the lender to change the rate. You've had it for 5 years. Now it's going to change monthly. So after the 60th month, it's going to change index plus margin. So that's the adjustment period. And after that time, the adjustment period is yearly. And once again, common adjustment periods today are 5/1 arms, 7/1 arms. So they're fixed for 5 years and they change annually after 60 months. Or a 7-year, you fix for 7 years and changes annually after that. Caps are important because somebody doesn't want to get payment shock. If you go from 2% to 8%, somebody will probably have payment shock and not be able to afford their home and go into foreclosure. With most conventional loans, the payment cap on the adjustment period is 2%. On government loans, FHA and VA, and they do have adjustables, and they're 5/1 and 7/1 adjustables, they have 1% caps. So if you're starting at 2% on a government adjustable and you have a 1% cap, the worst you're going to be after it changes is 1%. And lifetime caps, government caps on theirs are 5%. So the worst you'd ever be is 7% if you started at 2. And likewise on conventional loans, lifetime caps for the most part are around 5%. Negative amortization, we talked about that. It's when you're making a payment that doesn't cover your fully indexed rate. You're making a payment of 2%, but really you owe the bank 5%. There's a 3% difference. That goes back to your principal balance. So your mortgage loan amount is going to grow. So that's negative amortization. Those were popular with option arms, and they're gone today. They're not available because you don't want to have negative amortization. So the financing process, as your package gets into the underwriter, they're going to look at a number of things. There's 3 basic ones. Credit. How's your credit report at this time, and how has your history been? Do you make payments on time? Have you had collections, charge-offs, bankruptcies, things of that nature? They'll take that in consideration in doing your loan and considering your approval or denial. Capacity means income. Can you support that mortgage? How much do you consistently make on a regular recurring basis in income to pay that mortgage? And then collateral. That's the appraisal. So you want to qualify the property with a good appraisal. Make sure that that appraised value is equal to or greater than your sales price. Normally the approving process, even with the underwriters, they'll stand by a decision as long as the documentation, meaning your pay stubs, W-2s, tax returns, bank statements, they support the information that's going into the automated underwriting system, desktop underwriter or loan prospector. If it comes back with an approval, you're approved. So in order to close the loan now too, you have to have the CD or closing disclosure. Once the loan's processed and it's ready to disclose, the CD goes out, or closing disclosure, which shows what you're closing at, what's the interest rate, what's the term, can it change, are there prepayment penalties? All that has to be on there. You need to sign that before it goes to consummation, meaning signing your loan docs and closing. Then you have 3 days once the CD goes out before you can sign your loan documents. And after that, the loan is serviced by the lender. So in review in the financing process, it's qualifying the buyer, character or credit history. What are the FICO scores? How's your financing history been in the past? How have you been making your rent payments on time? They'll also look at capacity. They're looking at regular and recurring income, and also collateral. Is the collateral good? Meaning, does a property appraise? Now, oddly enough today, what you'll see if you have a really good borrower and they have good equity in the property, you may get an automated appraisal, meaning an escrow waiver. You don't have to pay for one. If the desktop underwriter or loan prospector comes back and approves with an appraisal waiver, you don't have to get an appraisal. So the financing process, you're going to evaluate the borrower's credit history. What are the FICO scores? Are there any late payments? Do you have any negative credit information? How long has credit been established? That's important too. If you don't have a FICO score, many times you can't get a loan. So you need to establish some credit. How much credit do you have? If you have a bunch of credit cards, for example, with large balances or maybe even zero balances, there's potential there to increase your debt to income ratio if you go out and use those credit cards. Length of time of your present residence is important too, in addition to your employment history. Normally, minimum, you want to see a good 2 years credit history. If it's 3 years, that's even better. Once again, in the financing process, we're looking at a borrower's capacity, their income. So a couple of definitions. One is the front end ratio, and basically that's your house payment, principal, interest, taxes, and insurance divided by your gross monthly income. Now the book says it should be around 28%. That's a pretty good guide, but it can be flexible based upon how it goes through the desktop systems. The back end ratio is the one you're really looking at. What kind of other bills do you have? So it's a PITI plus all your long-term debt, credit cards, MasterCard, Visa, car payments, student loans, those type of things, divided by your gross monthly income. The book says 36, but in today's market with desktop underwriting and loan prospector, you ought to be within a 43 to 45 for your back end debt to income ratio. The Dodd-Frank law that came out after the mortgage meltdown, one of the things that it did was it prohibits a lender or broker from attempts to influence an appraiser, meaning I really have to have this appraisal up before I can do my refinance, or the real estate agent says I can't get any more loans or any more loan referrals from her if the appraisal comes in short and screws up their deal. Well, in today's market, a lender can't even speak to the appraiser. What happens when you order an appraisal, you go into an AMC, which is an appraisal management company, order your appraisal, and then it goes out to an appraiser who will appraise the property, and then that'll come back and get submitted directly to the lender. But a loan officer during that time cannot even contact the appraiser. Real estate financing, we need to talk about the Truth in Lending Act because that protects the borrowers. The Truth in Lending Act pertains to 1 to 4 units. So single family condo, 2, 3, or 4 units. Within 3 days of an application coming in, the lending company has to give out a disclosure called an LE or a lending estimate. And that'll estimate down payment, monthly payment, estimate for taxes, insurance, and other assessments, estimate of closing costs, and cash required to close. So that's really important if you're going out to purchase a property. You need to understand if you can afford it and if you have the cash available to close. In addition to, one of the things that has to be disclosed is how your loan decision was based on. And they'll disclose the credit scores that were on your credit report that led to the underwriter's decision, either approval or adverse action, that means denial. The Truth in Lending Act, and one of the things it does on the LE is it lets the borrower know what their annual percentage rate is. Annual percentage rate is not the note rate. You take the note rate and then you take into account total cost of financing, calculated at a yearly rate, and that's an APR. So all the fees that are included for you that you're paying to get that note rate. For example, if it's 3.5, but you have to pay 2 points to get it, plus $1,000 underwriting fee, that's taken into consideration and reflects in the APR. The higher the APR or the spread between the note rate and the APR means you're paying a lot of fees. In addition to, some loans have a 3-day right of rescission. Refinances always do. 3-day right of rescission means this: before you close on a refinance, you have 3 days, you have a right to cancel. If you sign your loan documents and your funding is 3 days out, you can, within those 3 days, call the lender and say, I want to cancel. The Truth in Lending Rule also does a couple of other things. It's for first loans, from 1 to 4 unit residential properties, so not commercial, residential properties, and it gives the person applying for a loan an estimate. And the reason it gives them an estimate, it allows them to compare loans. And before close of escrow, those fees should be the same as the initial disclosure. If the closing disclosure is different, then you may have an issue because you have to sign the closing disclosure first before you go on to sign your loan documents and close. So there can't be any tolerance differences on those before somebody closes. And once again, the initial loan estimate allows consumers to compare loans. The Fair Credit Report Act says a number of things. If somebody's going to receive an adverse action or be declined because of credit, they need to find out what those credit scores were that caused the underwriter to decline the loan. So they need to get an adverse action statement out within 30 days and let them know that they're declined, and these are the credit scores used to determine your denial. The Equal Credit Opportunity Act prohibits discrimination based on race, creed, color, religion, national or marital status, age, and public assistance status. The application gathers information based on these things I just mentioned and is reported to the government, and it's called HMDA reporting. So the government will do a study based on somebody's national origin, marital status, and so on, and also look to see who is approved or declined and make sure that there isn't any crossover or banks and lenders aren't discriminating upon in anybody getting a loan based on the Equal Credit Opportunity Act. California Homeowners Bill of Rights. Basically, if somebody's going into foreclosure, that person has rights. If a loan modification and application has been submitted, then the lender cannot continue with a foreclosure. The homeowner, in that case, must also have a single point of contact. Lenders must verify all documents filed. Borrowers can seek to review any material violations in the foreclosure process. Tenants also have rights too. Say, for example, that somebody's in foreclosure, they're losing their house, but you have a tenant on the property. Well, the tenant's rights in that contract must be honored. If it's a one-year contract, that one-year contract has to be honored. If not, say it's a month-to-month, they need to be given a 90-day notice. Service Member Civil Relief Act of 2003 basically protects military people that are sent overseas. So it limits the interest on their credit obligations and also may defer those. It can provide postponement of foreclosure until 90 days after active service. So it delays the process. So if you're overseas, maybe somebody has served in Desert Storm and you leave and it's difficult for you to make your housing payments, then this act comes in and protects you from foreclosure. It also can allow for the termination of a lease upon military transfer. So if you're being transferred overseas and you just signed a one-year lease, you can get a termination of that lease from this act. California law has, as well as federal law, has done a good job at prohibiting predatory lending. During the mortgage meltdown, a lot of loans were made without considering a borrower's ability to repay, and they refinanced them frequently so they could pull out cash, but ultimately left them with a large loan amount and payment that they couldn't afford later. So when the payments got high, say that option arm was maxed out and needed to be paid, and the loan to values on homes increased, meaning now that your home, your mortgage, you had a mortgage, say $500,000, but now the home was worth $300,000. A lot of people decided to turn in their keys and just go straight into foreclosure because the property wasn't worth that to them anymore. But ultimately what happened with predatory lending, they took advantage of a lot of people and pushed them into a negative situation in regards to their mortgage, which led to a lot of foreclosures.